Welcome to our comprehensive guide on financial risk management. In this video, we'll explore fundamental strategies to identify, assess, and mitigate financial risks. Financial risk management is the process of identifying, analyzing, and mitigating unforeseen risks to an organization's capital and earnings. This is crucial because managing these risks can mean the difference between success and failure in finance. For finance professionals, business students, and investors, understanding financial risk management is essential for maintaining financial stability. Throughout this course, you'll acquire actionable insights and strategies to safeguard your financial interests. As we delve deeper, you'll see how identifying, assessing, and mitigating financial risks can empower you to make sound financial decisions. Financial risks are more than just numbers on a spreadsheet. They can disrupt entire businesses, jeopardize investments, and shake the backbone of organizations. Poor risk management isn't just a minor misstep, it's a potential catastrophe. From unforeseen market shifts to credit defaults, the consequences of ignoring financial risks can be severe. Understanding and managing these risks is essential. In this video, we'll decode financial risks and explore how to protect your assets and ensure stability. As we move forward, you'll see how crucial it is not just to identify risks, but to proactively manage them. Welcome to the crucial first step in financial risk management, identifying the various types of financial risks. Managing these risks effectively becomes daunting without a clear understanding. Let's begin by exploring the primary categories. Market risk stands as one of the foremost concerns, referring to potential losses due to changes in market prices. Next, we have credit risk, which is the risk of loss arising from a borrower's failure to repay a loan or meet contractual obligations. Loan defaults and bond downgrades are prime examples. Liquidity risk involves the inability to meet short-term financial demands due to an inability to convert assets to cash quickly. Finally, there's operational risk, which includes loss from inadequate or failed internal processes, people or systems, or external events like system failures and natural disasters. Identifying these financial risks is the foundational step for subsequent risk management strategies. By pinpointing where these risks lie, one can assess their potential impact and develop strategies to mitigate them. As we continue, we'll explore each type of risk in more detail, examining real-world examples and practical strategies to handle these challenges effectively. Understanding these risks prepares us to face them and empowers us to make informed decisions that safeguard our financial stability. Market risk refers to the potential loss due to changes in market prices. This kind of risk is intrinsic to investing and financial management. For instance, fluctuations in stock prices can cause significant losses for investors. Changes in interest rates can impact the value of bonds, mortgages, and other fixed-income securities, leading to financial setbacks. Understanding market risk is crucial for any finance professional. By recognizing the unpredictable nature of market prices and their potential impacts, you can better prepare and strategize to mitigate such risks. As we move forward, you'll see how identifying and managing these risks can protect your financial interests. Let's delve into the concept of credit risk, a fundamental aspect of financial risk management. Credit risk is the potential for financial loss if a borrower defaults on their obligations or if there is a significant downgrade in the credit rating of financial instruments such as bonds. For instance, when a borrower fails to repay a loan, the lender faces a significant risk of financial loss. Similarly, bond downgrades can erode the value of an investment portfolio. Understanding the nature and ramifications of credit risk is essential for effective risk management. As we move forward, you'll see how various financial risks are identified and approached. Liquidity risk arises when an entity cannot meet its short-term financial obligations, leading to serious financial instability. Imagine a business unable to pay its suppliers on time due to insufficient cash flow. This is a classic example of liquidity risk that could cascade into severe operational issues. Another instance is the inability to sell assets quickly without a significant loss, which ties up resources needed elsewhere. By understanding and identifying these scenarios, you can anticipate and mitigate the impacts of liquidity risk on your financial health. As we delve deeper, you'll discover effective strategies to manage these risks efficiently, ensuring stability and confidence in your financial operations. Operational risk is an essential consideration in financial risk management, encompassing the risk of loss due to failures in internal processes, systems, or from external events. By definition, operational risk arises from daily business activities and can have significant impacts if not identified and managed effectively. For example, instances of fraud, whether internal or external, can lead to substantial financial and reputational damage. System failures, such as IT infrastructure breakdowns, can disrupt operations, causing delays and economic losses. Additionally, natural disasters like earthquakes or floods can halt business activities, leading to considerable operational setbacks. Understanding these examples highlights the importance of recognizing operational risk early. As we move forward, you'll see how assessing these risks can create robust strategies to safeguard your organization against potential threats. Once we've identified financial risks, the next step is assessing their potential impact. This involves both quantitative and qualitative methods. Quantitative risk assessment relies on numerical data and statistical models. It involves calculating potential losses using metrics such as value at risk, or stress testing various financial scenarios. These models provide precise measurements, offering a clear picture based on historical data and predictive analysis. On the other hand, qualitative risk assessment involves a more subjective approach, often based on expert judgment and risk matrices. This method evaluates risks by considering factors that may not be easily quantifiable, such as market sentiment or geopolitical events. Through interviews, surveys, and risk workshops, qualitative assessments help gauge perceptions and consider broader impacts. Both methods are integral to a comprehensive risk assessment strategy. Quantitative techniques give us hard data and specific metrics, while qualitative approaches provide context and insights. Balancing these methods can lead to thorough risk management. Incorporating multiple perspectives ensures a robust analysis, allowing for well-rounded strategies that address both the tangible and intangible aspects of financial risk. As we move forward, you'll see how these assessments feed into developing strategies to mitigate risks, leading to more resilient financial planning and decision-making. In quantitative risk assessment, statistical models play a pivotal role in estimating potential losses. One widely recognized method is value at risk, or VR. VR quantifies the maximum potential loss over a specific time frame, given normal market conditions and at a certain confidence level. By calculating VR, finance professionals can gauge their exposure to market movements and make informed decisions to safeguard their investments. This approach provides a robust framework for anticipating risks and designing effective risk management strategies. As we move forward, you'll see how qualitative assessments complement these quantitative measures, enriching the overall risk assessment process. In our journey through financial risk assessment, we now arrive at qualitative risk assessment. This method primarily leverages expert judgment and risk matrices. By tapping into the experience and insights of industry experts, we gain nuanced perspectives on potential risks. Risk matrices systematically rank and prioritize these risks based on their likelihood and impact. Unlike quantitative methods, which rely on concrete data and statistical models, qualitative assessment provides a more descriptive analysis, often essential when numerical data is scarce or imprecise. As we move forward, you'll discover how to effectively use these qualitative insights to develop robust financial risk mitigation strategies. After a thorough risk assessment, it's time to put strategies in place to manage those risks effectively. The first strategy is risk avoidance, which involves steering clear of activities that present substantial risks. For example, a company may choose not to invest in volatile markets to avoid significant financial loss. Next is risk reduction, taking steps to lessen the likelihood or impact of risks. Implementing safety measures in operations or enhancing cybersecurity to prevent breaches are prime examples. Risk transfer shifts the burden of risk to another party. Insurance is a common tool for risk transfer, where a company pays a premium to an insurer to cover potential losses. Finally, risk acceptance involves acknowledging the risk and preparing to handle its consequences. This approach is taken when the cost of mitigating a risk outweighs the potential impact. Each of these strategies can be tailored to fit the unique context and needs of your business. The key is to understand and match your approach to the nature of the risks you face. Now that we've outlined these strategies, let's take a deeper dive into each one, starting with risk avoidance. We'll explore real-world examples and practical steps you can implement in your risk management plan. Ready to see how these strategies come to life? Stay with us as we move forward to break down each approach in detail. Risk avoidance involves taking proactive steps to eliminate a risk entirely. By sidestepping potential pitfalls, organizations can safeguard their stability and future growth. For example, a company might choose to avoid entering a high-risk market altogether, foregoing opportunities in volatile regions or sectors to maintain a more secure footing. Understanding risk avoidance is crucial as it helps in planning and implementing strategies that steer clear of pitfalls rather than just managing them. As we continue, we'll explore additional strategies to handle financial risks effectively. Risk reduction is a crucial step in financial risk management. It involves taking proactive measures to minimize the potential impact of identified risks. For instance, a company might introduce stringent safety protocols to mitigate operational risks that could disrupt daily activities. By implementing such safeguards, the company not only protects its assets, but also fortifies its operational resilience. Understanding and applying risk reduction strategies can save organizations from significant financial losses and operational downtime. As we move forward, we'll explore more strategies to effectively manage financial risks, ensuring your organization is well equipped to handle potential challenges. Let's delve into the concept of risk transfer. Risk transfer involves shifting the risk to another party, effectively mitigating potential negative impacts on your business. For instance, consider purchasing insurance. When a company buys insurance, it transfers the financial burden of specific risks to the insurer. This approach allows businesses to focus on core operations without the constant worry of certain financial risks. Understanding risk transfer is crucial in developing a robust financial risk management strategy. As we move forward, you'll discover other methods to handle financial risks effectively. Risk acceptance involves acknowledging a risk and deciding to bear its impact. It's a conscious decision often made when the cost of mitigation exceeds the potential loss. Let's consider a practical example. A small company may choose to accept the risk of minor data breaches due to the high cost of advanced cybersecurity systems. Similarly, an investment firm might decide to hold a volatile asset, accepting the risk of fluctuations due to potential high returns. Understanding these scenarios helps you grasp the essence of risk acceptance, where the strategic choice is made to tolerate certain risks. As we move forward, you'll see how these principles apply in different financial contexts, paving the way for well-informed risk management decisions. Implementing risk management strategies is a critical phase where theory turns into practice. This involves putting each strategy into action and ensuring they function as intended in real-world scenarios. The first step is to clearly define roles and responsibilities. Every team member should understand their specific duties in managing and mitigating risks. This clarity helps in seamless execution and avoids redundancy or oversight. Next, allocate sufficient resources. Whether financial backing, technological tools, or human capital, providing adequate support ensures the strategies are executed effectively. Setting up monitoring mechanisms is also key to track progress and effectiveness. Regular reviews help identify any deviations or issues early on, allowing for prompt corrective actions. Metrics play an important role here. Establishing key performance indicators, KPIs, allows us to measure the success of our risk management efforts. Effective communication is paramount. Keeping all stakeholders informed fosters transparency and accountability. Regular updates and reports maintain confidence and support from top management and other relevant parties. Post-implementation reviews provide insights into what worked well and what needs improvement. This iterative process ensures that strategies remain robust and effective. As we move forward, we'll explore a real-world case study that highlights successful implementation of risk management strategies, providing valuable lessons and insights. Let's dive into a real-world example of successful risk management. Our case study revolves around a company that faced significant market fluctuations and industry-specific risks. The company started by pinpointing key areas of vulnerability, such as market volatility and credit exposure. They used quantitative risk assessment methods, harnessing statistical models to gauge potential losses. This approach enabled them to quantify risks accurately and prioritize their mitigation efforts. They incorporated qualitative assessments, leveraging expert judgment and risk matrices to evaluate the likelihood and impact of various risks. Armed with this data, the company developed and implemented a multifaceted risk mitigation strategy. This included risk avoidance by steering clear of highly volatile markets and risk reduction through diversification of their investment portfolio. They employed risk transfer techniques, such as purchasing insurance to cover specific risks, effectively buffering against potential financial losses. They balanced this with risk acceptance for low-impact scenarios, where the cost of mitigation outweighed the potential risk. Optimal implementation was key. The company ensured that each strategy was put into action seamlessly, with continuous monitoring to adapt as conditions changed. This proactive approach enabled them to respond swiftly to emerging risks and maintain stability. From this case study, we learn the importance of a thorough risk identification process, the value of combining quantitative and qualitative assessments, and the effectiveness of a diversified mitigation strategy. These steps, coupled with diligent monitoring and the willingness to adapt, are critical for successful financial risk management. As we move forward, you'll discover common pitfalls in risk management and how to avoid them, ensuring your strategies remain effective and robust in the face of challenges. While implementing risk management strategies, it's crucial to be vigilant about common pitfalls. Misidentifying key risks or underestimating their impact can undermine your entire framework. Poor communication across teams can also lead to missed signals and increased vulnerabilities. To avoid these mistakes, ensure thorough risk identification and accurate assessment. Foster a culture of open communication and continuous learning within your organization. Regularly review strategies and be ready to adapt as new information and risks emerge. As we move forward, you'll see how proper vigilance can transform potential pitfalls into strengths, keeping your risk management robust and effective. Risk management is an ongoing process. Regular review and continuous improvement are essential to ensuring the effectiveness of your strategies. By consistently evaluating your risk management plans, you can identify areas for improvement and adapt to changing financial environments. Implementing a cycle of continuous improvement allows you to refine your approach, making your strategies more resilient and effective. Remember, the goal is not just to address known risks, but to be proactive and innovative in anticipating future ones. As we move forward, you'll see how an agile approach to risk management keeps your financial strategies robust and forward-focused. In conclusion, financial risk management is crucial for maintaining financial stability. Throughout this guide, we've explored essential strategies to identify, assess, and mitigate financial risks. Understanding different types of financial risks, like market, credit, liquidity, and operational risks, better prepares you for potential challenges. We discussed both quantitative and qualitative methods to assess these risks and the importance of developing robust risk mitigation strategies. Remember to implement these strategies diligently and engage in continuous review and improvement. By doing so, you can protect your financial interests and ensure long-term stability. Thank you for joining us on this journey to mastering financial risk management.